2023, May 10, Financial and Management Accounting. So you are a team leader of a group of consultants responsible for preparing research report on financial performance and financial position of the listed companies on LUCE. A research consultant under supervision has analyzed the latest report for AAPLC listed on LUCE, and the following is the analyzed summary. So gross profit, margin 2021, 2020, so 38. Industry averages. So we need to analyze this information. So we need to prepare a report. Okay. Now, in analyzing this, let's start with our gross profit margin. So we can see that AA's gross profit margin has remained steady at 38% in 2021 and 2020, which is slightly lower than the industry average of 45% for both 2021 and 50% for 2020. So as you can see there, it simply suggests that AAPLC is actually facing challenges in maintaining competitive edge in cost control compared to its industry peers. So let's look at the return on assets. What can we comment on return on assets? So as you can see from there, the return on assets has declined significantly from 6% in 2020 to 3% in 2021. So what does that mean? It indicates that the company, in terms of efficiency generated from its asset, has decreased. Okay. So the industry average is 5% for 2021, which surpasses AA's PLC performance, reflecting that there's potential inefficiencies in the company's operations. In terms of return on equity, here yes, please.
Yes, again, the explanation on return on the total assets.
So return on total assets, so we're looking at 2020. So this is a smaller A, so there's a decline. So return on assets basically talks about how much we're utilizing our assets to generating sales. So there's a decline. So you're also comparing it to the accepted industry averages. So this guy is comparing to this, this one's comparing to this. So to start with, there's a decline from 3% to 5%. All right. So we're not performing. However, for 2021, we are above the industry average. For 2020, we're actually below the industry average. The return on equity, both of them are below the industry averages. However, there's an increase from 1% to 2%. Okay. There's an increase from 1% to 2% together. So this indicates an increase. Let's go to liquidity ratios. Liquidity ratios, which ones are the liquidity ratios of the current ratio and the test ratio? So we are seeing a decline from 4.9 to 2.5. 4.9 to 2.5. So this one, for 2020, all of them are above the 2 to 1, but for 2020, it is above the 4.0, whereas 2021, we underperformed based on the industry averages. So based on that, there's an improvement from 2.5. There's actually a decline from 4.9 to 2.5. So if we look at the acid test ratio, there's a decline from 1.8 to 1.5. However, for 2020, we are underperforming. For 2021, we're at par. So despite the increase there, we are showing there being um, a decrease in performance. Interest cover is a decline from 1.4 to 0.9, and both of them are below their industry averages. Under competitive ratios, we're also below them. Then final debt to equity ratio, there was an increase from 55 to 65. Of course, we were above the industry averages in both. In a nutshell, we can also go. Yes, please.
Yes, in an exam, can we just talk about the comparisons, or we can even state what could be the reason for maybe the reduction or the increase in the performance?
Like we mentioned yesterday, you could also attribute that to uh, the cause. So this analysis specifically, like I mentioned here, when we're talking about the gross profit, both of them were below. So we are failing to manage our expenses, our cost of purchases. Okay, then here you need to mention the cause behind there because you're interpreting it in depth. So if we're talking about efficiency ratios also, or we can classify them under what? Yes, efficiency ratios or activity ratios. We have the debt collection period, which we have there. So average debt collection period increased from 25 to 35. So there was an improvement in 2021, meaning our debt collection department was doing a good job in ensuring that they collect on time. However, in 2021, we're behind by 5 times below the industry average. All in all, we outperformed the competitors in 2021, but in 2020, we're below. When you go to the average credit payment period, this looks at the time period it takes for us to pay our debt. So we're above the industry averages on both accounts, except that we were beaten by our creditors, our competitors on both scoreboards. So it took too much time for us to pay back our debts. So this compromised our creditworthiness with our creditors. Okay. Then the debt to equity ratio, you got 55. So debt equity ratio looks at the ratio by which our institutions are financed by debt compared to equity. So the industry is. Okay, any questions so far? So I could also allow from your end any contributions on the analysis, since we talked about this. Can you comment on the capital structure?
Hello?
Yes, please.
Are you getting Mr. Collins?
Yes, I can. I can. Can you hear me? Can you get me? Hello? I can hear you. Hello, can you hear me? Can you get me? I can hear you,
Yes,
Mr. Yeah, you can proceed.
yes. On the capital structure, I'm thinking like since there is an increase from 2020 to 2020, 65%. This means that it could have been that maybe we obtained some loans, or maybe there is the shareholders have more. Hello?
Yes, I can hear you.
Yes. So what I was trying to say is there's an increase from 55 to 65%. So this entails that there's an increase in terms of the long-term debt, or it could be that the shareholders have sold the shares, which has led to the reduction in equity, and which has changed now the capital structure by increasing the debt ratio.
Oh, that's great. Yeah, I like the dig-in analysis. Any additions? Any other ratios?
On the Hello?
Yes, I can hear you.
Yes. So on the efficiency ratio, if you look at the debt collection periods, we are increasing from 25 days to 35 days. So this means that in terms of collections, we are not collecting, we have increased the debt, which will affect our liquidity, because we are now taking long to collect money from our receivables. Again, and this has also led to the increase in the payment days from 55 to 60. And this could have been the result of maybe the increase in the collection period, which has also affected the payment days. And this can affect our reputation with suppliers.
Okay, great. That's very good. The others? Okay, then let's go to part B, where we now need to conduct a financial statement analysis. So in conducting financial statement analysis, there are many methods that are used, including vertical and horizontal analysis. Describe these two methods and explain the key differences between the two methods. So the vertical analysis basically involves us expressing each line item on the financial statement as a percentage of the base figure within the same period. So it's basically used in understanding proportional relationships between different components of the financial statements, like revenues, like expenses, like assets, as well as facilitating comparisons over time. For instance, if our net income is 100,000 kwacha and our total revenue is 500,000 kwacha, then our net income as a percentage will be 100,000 over 500,000, which is 20%. So this is how we use the vertical analysis. So horizontal analysis is used to compare financial data over different periods to identify trends and changes in performance. In terms of usage, it is basically used in the direction of the magnitude of the changes based on their financial metrics over time. So it actually provides insights into the company's performance trajectory. So if, for instance, our net income is 80,000 kwacha, and the previous year we had 100,000 kwacha in the current year. So the horizontal analysis here will be 100 minus 80 over 80 times 100, which gives us 25%. So basically the differences here from my explanation are in terms of focus, in terms of purpose, in terms of comparability. So in terms of focus, vertical analysis will focus on proportions within a single period, whereas horizontal will focus on analysis across multiple periods. In terms of purpose, vertical analysis will help us understand the composition of financial statements, whilst horizontal will just help us in assessing the trends of performance in time. Comparability, vertical analysis will facilitate comparison just within a single period using a base year, whilst horizontal will actually cut across multiple periods. So in conclusion, these are two methods of analysis that are very valuable in financial statement analysis. They give us different perspectives of a company's performance and position. So this is how,
According
yes.
from your explanation, are you able to give an example based on the AAPLC? Because I think we can give an example if you look at the horizontal, where we are comparing with the periods, the
Okay, so
trends from 2021.
the
Yes,
problem, okay, so the problem with this is that this is just a summary. We don't have our sales. So if we had an income statement, it would be easy. So to explain that, maybe we'll look at it in another session where I have the statements there. So one is within, the other one is using years. Okay, so
noted.
yeah. Okay, so thank you for your submissions and contributions. We can look at question number 2. So a company is considering investing in a new project. The following financial information has been provided to conduct investment appraisal to analyze project sponsors whether the project is viable. 5 marks question part 1. Use examples to explain the importance of working capital in project planning. So what is the importance of working capital? So we can talk about 5 uses. Number 1, working capital, initial working capital, basically, or to be specific, is essential for planning purposes for several reasons. Number 1, for smooth operations. So it will ensure that the project has sufficient liquidity to cover daily expenses like salaries, utilities, raw materials. Without adequate working capital, a project may face disruptions. Flexibility. So having adequate working capital will basically provide capital in managing unexpected expenses or to take advantage of unforeseen circumstances. So it will allow the project to adapt to changes in market conditions and also unexpected events without compromising operations. Thirdly, it helps support growth. Initial working capital can support a project's growth initiatives by providing funding for expansion plans, like increasing production capacity, entering new markets, also for providing financial resources that will be needed in investing for growth opportunities. Initial working capital will also be vital for supply and creditor confidence. So when we have adequate working capital, it signals to our suppliers when they call upon us. And a project is financially stable, we're able to meet our debt obligations on time. So it can lead to better credit terms, discounts, and also improved relations with our stakeholders. And finally, in industries where cash conversion cycles are lengthy, like in manufacturing and construction companies, so working capital will serve as a buffer or a bridge to gap between the initial cash outflows, expenses, and cash inflows from sales or collection. So it will ensure that the project can operate smoothly during periods of slow cash conversion. So in summary, in a nutshell, initial working capital is very, very important for smooth operations, for flexibility, for growth. It will provide financial foundation necessary to cover our daily expenses. All right, so we have been given a scenario here where we have our annual profits, year 1 up to 6, net cash inflows, year 1 up to 6. So we're asked to calculate AAR, NPV, profitability index, and payback period. Okay, so we're given a cost of capital of 15%. So once we help, how do we calculate the accounting rate of return? What's the formula? It's the average annual profits over the initial investment. So our profits here, we add all these divided by 6. What are we getting? Are we adding? A AR. To say the formula, average annual profits over initial investment.
Will be ARR, not AAR.
ARR. Okay. Average annual profits over initial investment. Okay, so what's the total here? What's the average that we have here? And our initial investment was how much?
$5 million.
What is our average here? Negative 350 plus 250 plus 400 plus 550 plus 570 plus 600 equals divided by 6. Okay, so this is what? 336,666.67. Okay, so our average is what? 336,666.67 divided by how much?
5 million.
Okay. So what are we getting? Times 100, 6.7%. Okay, so the lowest mark here, AAR. Okay, so this is, I will get it ARR. Are we together?
Yes.
Then we go to our net present value, is the summation of the cash flows minus the initial cash outflow. So we are going to discount each of these figures here. Okay. Our initial cash outflows by our cost of capital here. So we're going to discount each of these figures here. So what is our first figure?
300.
300, yes.
Then 436,000.
So we're going so we're dividing this one by what? 1.15 to the power 1. This one 1.15 to the power 2, 1.15 to the power 3, 1.15 to the power 4. So NPV is given by what? Summation of our cash flows, 1 plus R, the power time, and that's the initial cash outflow. So here our first cash outflow, we're looking at what? So as we are looking at the NPV, we must understand that a project is only as viable when our NPV is positive. If it's negative, it's not viable. Secondly, you must also, if you're given two projects, one with a higher NPV as what is more profitable than the other. Okay, so you also need to understand the advantages and disadvantages of NPV, which we discussed yesterday. What are the advantages and disadvantages of NPV? At least 3 of each of them. So 300, 4, 36, 15. So 300, 436, $1,500, $1,013,500. And 3, and 500. Minus what? 5 million. Okay. Are we together? Are we following?
Yes.
So we discount each of these ones. So what we have, the first one, 300, 123 times 0.15 to a negative 1. So same as over that. So here we're going to have 260, 869.57. Okay, the second one, 436,000, 1.15. 329, 678.64. The third one, 15, 3, 5, negative 3. This one would be 986, 274, 3, 3, 5. Okay, now help me then last. I want to try last 3.
The last three starting from where 113. Starting from 1 million, eh?
Yes, from 1 million.
571, 753.
Yes. 571, 753.25.
646, 329.76. 646, 329.75.
Okay. Let me verify it. 646, 329.76. Yes. And lastly, 500,000.
In 163.7.80.
163.80. Okay. So when you add all these, we get the summation of the cash flows. So let's sum it. Starting with this one. 268.69.57 plus 329.678.64 plus 986,274.35 plus 571,753.25 plus 646,329.76 plus 216,163.80. What do we get? 3,011,069.37. Is that what you're finding? So NPV
Yes,
is equal to
that's correct.
summation of cash flow minus initial cash outflow. So you subtract this minus 5,000, 5 million. We're going to get negative what? So we're doing 3,011,069.37 minus 5 million. We're going to get negative 1,988,930.63. So our NPV, since NPV is what? Less than 0, which is negative,
Negative.
so it's not viable.
The project.
Okay, then profitability index is simply equal to the summation of the cash flow over the initial cash outflow. So here we're dividing now the 3 million. So this sign now becomes divided by instead. Okay. So we have 3 million 0.11069.37 divided by, so this is giving us 0.6022. So profitability index is less than 1. Okay, if it's less than 0, it should be more than 1. If it's less than 1, it's not viable. So here our profitability index is signifying non-viability. So we already have our 12 marks so far. Are we together?
Yes.
Then our payback period. Remember what we did? 300, we add plus 436. We have what? 736. Right? One, two, three. So we have 300 per year. 1, 2, 3, 4, 5, 6. So we have 5,000. Dropping out the zeros. And we have 300. We have 436. We have 1,500. Have 1,000. We have 1, 3, and 500. So using our, we start with the 300 here, 736 plus 1, 5, we get what? 2236 plus 1,000, that's 3236 plus 1, 3, we have 4536 plus 500, we have 5036. So we look at where the 5,000 will lie. It will be between these two here. So here our A is here, our B is there, our C is the 4,000, and our D is the 500. Payback period will be A plus B minus C over D. So here we have 5 plus 5,000 minus 45, 36 over what? 500. Okay. So 5,000 minus 45, 36. So this will give us what? 464 over 500. So our final answer would be 5.928 years. So we discussed this yesterday, remember? Are we together?
Yes, following.
Okay, Mr. Franklin, are we on the same page? So advise on the viability of this project. So based on financial viability,
Not viable.
AAR,
It's
we
not
found
viable because I think
it was below the, yes? Our NPV was negative, not viable. Our
the
ARR
paper,
was below cost of capital, not viable. Our profitability index was below 1, not viable. Payback period was 5.9, which exceeds the expected duration, not viable. So considering all these factors, I would advise sponsors of the project not to finance this because NPV is negative, low ARR, there's extended payback period, which suggests that the project is unlikely to generate sufficient returns to justify our initial investment. So even though the working capital was provided, the sponsors should reconsider proceeding with this project and explore alternatives. So this is a recommendation you can give. Okay. We're together.
yes.
So we can now go to question number 4. Your friend Jumbo has been carrying on business on rearing chickens for the past few years on an informal basis. The business was not registered with PACRA or with ZRA, however, she was approached you to help her formalize the business, start keeping her books of accounts, and preparing financial statements. She's aware she can formulate a business by registering it as a partnership, limited company, or sole trader, but she seeks advice as to which form of business she can register. Advise Jumbo on the advantages and disadvantages of a partnership, a limited company, and a sole trader. We know that a partnership basically has advantages of shared responsibilities, combined resources, tax benefits, and flexibility. So shared responsibility in that partners will be allowed to share responsibilities, the workload, decision-making, and also reducing the individual burden. Combined resources, advantage in that partners can pool the resources together like skills, expertise, multiple individuals who facilitate growth and expansion. In terms of tax burdens, partnership generally are not subject to double taxation like in companies. The profits here are basically distributed among the partners and they're taxed as the individual taxes. So we also look at flexibility. Partnership offers flexibility in management, operations, and allowing partners to adapt quickly to the changes in the business environment. The disadvantages are as follows: unlimited liability, conflict potential, limited, capital threshold, also limited lifespan. So in terms of unlimited liability, we know each partner is personally liable for the debts and obligations of the partnership, so they can put personal assets at risk. So conflict of potential disagreements among the partners can arise, and this will lead to disputes over the decision-making and profit sharing in the business direction. So limited capital partners may face limitations in raising capital compared to corporations. So these may rely primarily on their partners' contributions and loans. So limited lifespan, we know that partners will dissolve upon death, upon withdrawal or bankruptcy of a partner. So potentially this will disrupt what? Continuity. We go to limited company. Limited companies have advantages of limited liability, separate legal entity, access to capital, and tax benefits. In terms of limited liability, we know shareholders are limited to their investment. This will protect their personal assets. In terms of separate legal entity, the company is a separate legal entity from its owners, which provides continuity and stability. In terms of access to capital, limited companies will raise capital by issuing shares to investors in the equity market, obtaining bank loans easily. In tax burdens, corporate taxes may be lower than personal taxes, so shareholders can benefit from the tax-deferred investment of growth. Disadvantages are in terms of complexity and regulation, double taxation, cost, and loss of control. So complexity in that limited companies are subjected to more complex legal requirements, including registration, compliance, and reporting. Double taxation, where profits are taxed at corporate level, dividends are distributed to shareholders, and they are taxed again at individual level, so leading to double taxation. The cost of maintaining a limited company may be costly due to the registration fees, legal, as well as compliance expenses. Loss of control, we know that our shareholders have limited control over company's management in terms of decision-making, especially in a public traded corporations, because we are selling the shares and anyone can join. We go to a sole trader, the one-man business whose advantages are in terms of simplicity, direct control, tax efficiency, and flexibility. In simplicity, the sole traders will have fewer legal formalities and administrative requirements compared to partners and limited companies. Direct control, where the sole trader will have complete control over the business's operations, decision-making, and profits. The sole trader will also, in terms of tax efficiency, offset business losses against their income, potentially reducing their tax liability and flexibility. So traders will have flexibility to make quick decisions and adapt to the changing market conditions. The disadvantages basically are those of unlimited liability, limited resources, limited growth potential, and also business continuity. By unlimited liability means the sole trader is potentially liable for all the debts and obligations that the business may have, thereby risking their personal assets. They have also limited resources, which sole traders, SMEs, face in raising capital compared to larger businesses. And also, there's limited growth potential because a sole trader is limited to his own resources, skills, and capacity. Of course, he can as well borrow from friends. So we have business continuity disadvantage upon the death of a sole trader or illness, the business will die. So now, part B is asking us to explain why businesses should prepare financial statements, 5 marks. Now, why should businesses prepare financial statements? There are many.
Requirement.
Pardon?
For companies, it's a legal requirement.
Yes, for companies, it's a legal requirement, yeah. It's mandatory. Okay, so it's part of the FRS. So there are several other reasons that we could also add to that. Okay, why should they prepare financial statements? For decision making? So financial statements will give companies information upon which they would make decision on performance. From the cash flows, it will enable stakeholders to make informed decision about investments, whether they should invest in those companies, whether they should be able to lend, and also strategic planning. Transparency issues. So financial statement will also promote transparency and accountability. So when we disclose these to our shareholders and our investors and our creditors and regulators, they will be able to foster confidence in the organization. Compliance, like you said, preparing is not only an issue of choice, but it's part of the requirements. So to produce a financial statement, it's in accordance with the standards, accounting standards, corporate governance regulations, including the tax laws. Financial statements are also vital for communication. So these ones will communicate results of how the company has been operating. So it gives the financial health and future prospects for both internal and external stakeholders. So it facilitates communication and collaboration. Financial statements also are essential for evaluation and historical record. So we keep these records to save as basis for comparison over time. That's why we use financial statement analysis to see the patterns of growth. In terms of evaluation, they help stakeholders evaluate the company's performance, also to assess the financial health and stability and identify areas for improvement. So in a nutshell, financial statements play a very significant role in providing transparency, facilitating decision-making, ensuring compliance, and fostering trust and confidence in our organizations. So this is how our 5 marks are supposed to be collected. And finally, describe any 4 costs. Yes, sir.
Can we also include, like, for external stakeholders such as banks when you want to get a loan? Because the banks require the audited financial statements whenever you want to obtain a loan.
That's true. So they'll be used for such uses as well. Yeah. You can use the financial statements to obtain a loan. So financial statements that we actually use to get what we call discount invoicing. Sometimes you would want to show a bank to say, we have people who owe us from our financial records. So they'll be able to give you money. For instance, you have trade receivables with 100,000. You give them financial statements and records to say you can give us 80,000. When these ones pay us, so give you the full. So you are securing. So it's the financial statements that you use. Very true. Lastly, describe 4 costs that are incurred in the production of broiler chicken and classify each of the costs using the nature of expense method and classifying the costs. So any types of 4 costs that we know? In terms of broiler chickens, classifying them in terms of their nature, whether they're variable costs, they're mixed costs, including fixed and variable costs. So those of you who kept chickens, we have feed costs, which we can classify them as variable costs. Why are they variable? Because
What about the feed costs?
yes, the feed costs, yes, those are variable. Why are they variable? because they vary with the number of chickens you have,
Yeah.
and also based on the market feed prices, yes, of ingredients. We also have labor costs, which are variable, wages that are based on the number of workers that we have, the various tasks like
So,
feeding, cleaning, maintenance, and broiler chickens, yes. We also have utility
and
costs.
electricity fixed costs.
So utility costs like electricity, water, these ones have a mixed cost nature. Some may be variable, others will be fixed, depending on what tariff you're on. So we have cost of water, heating, cooling, maintaining optimal environment. So these ones are costs that um, these are costs that require they're variable and they're fixed. So you need to substantiate. So some may be varying with levels of production, others may remain fixed, like basic water supply, you have a certain amount of water that you need. And we also have veterinary health costs that are variable. These ones may include expenses for vaccines, medications, veterinary services aimed at preventing diseases. So overall health is dependent. It may vary depending on the pandemic or outbreak of diseases. So these costs are essential. And this examiner was trying to see how you're able to actualize and basically outline the cost based on um, the nature of business that we're talking about. Okay, so finally, on conceptual framework, the conceptual framework for financial reporting contains qualitative characteristics of financial information, namely fundamental characteristics and enhancing characteristics. So use these examples to explain how each of the following four enhancing qualitative characteristics will enhance the two fundamental qualitative characteristics of financial information. Explain also what measures have been instituted by the accounting profession to ensure that accounting information is truthful or valid. So you remember first of all, the fundamental characteristics and the enhancing characteristics that we have? We had created a formula. Hmm. Those who are joining my classes during remember this, cut what? It's cut VU, we also had RF. What are these acronyms that we made? So we have what we call enhancing qualitative characteristics. So we want to discuss the impact on the fundamental qualitative characteristics. So we have comparability, which is a C. The U is understandability. The T is what? Timeliness. Okay. The V is verifiability. The U is understandability. That's how we came up with this acronym, CAT VU. Okay. So how do these characteristics what are they and how their impact on the fundamental qualitative characteristics? So comparability by definition looks or refers to the ability to compare financial information across different periods among different entities. So the impact they have on relevance is that by providing consistent and comparable information, comparability will enhance the relevance of financial information. In an example, if a company A and B will use the same accounting standards and reporting methods, so investors can easily compare their financial performance and make informed decisions. All right, we're together. So the impact on and the other fundamental characteristics like faithfulness. So there are two fundamental characteristics that we know: RF, relevance, and faithful representation. So this question was very deep. So I want to look at how these two impact. So there are two fundamental characteristics, so relevance and faithful representation. So the impact in faithful representation is that comparability will enhance faithful representation of financial information by ensuring that similar transactions and events are accounted for and are presented in a consistent manner. So this will thereby reduce ambiguity and improve the reliability of the financial statements. So V for verifiability. By definition, verifiability is the ability to ensure that financial information is supported by what? Evidence, and can be verified by independent observers. Verifiability. So what is the impact on relevance and faithful representation? So on relevance, verifiability will enhance the relevance of the financial information. How? By providing assurance that the users of that particular information is reliable and credible. For instance, if the audited financial statements will provide assurance to the investors that the information that is presented is accurate and can be relied upon, then it will be deemed as verifiable. So we usually have auditors that come into our offices. So when these auditors come into our offices and they certify your books as being free from error, so when they are sent to a head office, or there is a certain level or degree of confidence that is attached with regards to relevance, that this can be used for decision making. In terms of faithful representation, the verifiable account also attribute as a faithful representation of what actually transpired as financial information, including the transactions, the events that were accurately recorded. So most of you become busy when auditors come in. So auditors are there to make sure that this information is verifiable. Of course, we know that sometimes some of you pay these people to just justify for the sake of audit queries. Timeliness, also we understand that it should cover a provision that information must be provided in a timely manner, allowing the users to make decisions promptly. What impact does it have on relevance? So timeliness will enhance the relevance of the financial information by providing timely insights into financial performance and the position of the entity. For instance, we have quarterly reports. So you need to allow investors to track the company's performance and respond quickly to the market. In terms of faithful representation, timeliness should also contribute to the faithful representation of the financial information by ensuring that it is current and reflects the most recent transactions. So this will reduce. Okay, so where were we? We're discussing the issue of what? The T, timeliness, how they affect relevance and faithful representation. So on the T, we say that in terms of faithful representation, timeliness contributes to faithful representation of the financial information by ensuring that it's current and reflects the truest and most recent transactions. The U for understandability. Understandability meaning it must be simple and easy to clarify, making it accessible for users with varying levels of knowledge. We know that sometimes not everyone is an accountant. Okay, most times, so we need information that is in that context. So understandability in terms of its impact on relevance, it must enhance the relevance of the faithful financial information by ensuring that this information is presented in a clear and concise manner, making it easy for users to interpret. For decision making, for instance, using plain language to avoid that complex jargon that most of you in your department like using. Okay, so this will improve easy information flow to the users who could be investors or stakeholders. And in terms of faithful representation, understandability must also contribute to faithful representation of the financial information, making it easier for users to understand the underlying economic transactions and events. So this will reduce the likelihood of misinterpretation and misunderstanding, thereby improving reliability. Okay. So this question was very loaded. So part B, explain the measures you have instituted by, explain what measures have been instituted by accounting profession to ensure that accounting information is truthful and valid. So what measures have been put? There are several measures to according to the accounting profession to ensure truthfulness and validity. These would include accounting standards, auditing, internal controls, corporate governance. These are the main. So in terms of accounting standards, we know they have been established and enforced by regulatory bodies like the International Accounting Standards Board, IASB, and the Financial Accounting Standards Board, FASB. These ensure that accounting information is prepared in accordance with the consistent, transparent rules. Auditing. We have independent external auditors who review financial statements that will ensure that there's compliance with the accounting standards and also assess accuracy, reliability of financial information. And these auditors will provide an assurance to the stakeholders regarding the truthfulness and validity of the accounting information. Internal controls, so organizations or departments in government will implement internal control systems to safeguard assets, to maintain these accurate records, and also ensure that there's compliance with the accounting policies. So effective internal controls will help to prevent errors, fraud, misstatements, financial reporting, and also enhancing validity. And finally, corporate governance. Strong corporate governance practices, including establishment of independent audit committees, oversight boards of directors. These will promote transparency, accountability, and also will ensure that there's ethical behavior. Financial reporting. So ensuring that there's appropriate oversight and also accountability mechanisms. So corporate governance will help to maintain the truthfulness, the validity of accounting information. So lastly, but not the least, we are going to end here. We're being asked by use of examples to describe the accounting information needs of the general public, government, journalists, and analysts. So describe accounting information needs to these four stakeholders: the general public, the government, the journalists, and analysts. How do they use financial accounting information? So to the general public, they are users of information in that they access this financial information to assess the stability of companies in which they wish to invest in. For instance, individuals will rely on such financial statements to evaluate performance and solvency before investing in. So there's certain banks like this bank invest trust. So the general public will want to understand, should have a certain level of accounting information so that as they're depositing money, their monies are safe. Government also will use this information for tax purposes to assessing how much must be paid. For instance, the DRA will rely on these statements to verify tax compliance and also assess the liabilities of taxes for such businesses. Journalists will use this accounting information for report purposes. In the Western world, we have financial journalists. They use such information to analyze performance of companies and industries. And these journalists will use to uncover financial irregularities and trends that would impact investors and the public. Analysts will use such information to evaluate opportunities and also assess financial performance and prospects of such companies. So they'll make informed investment decisions. For instance, when analysts will analyze such ratios and trends in certain companies using the financial statements, they'll give an assessment of the profitability, the liquidity, and financial health of such companies. So with that being said, we end here.